What's going on, guys? This is Lior and welcome back to the channel. Now, one source of confusion I get from quite a bit of you guys watching my videos and newer investors is the difference in commercial loans versus residential loans when you're taking a 25% down loan to buy an investment property, right? A lot of you guys are in that stage where you're trying to figure out the best financing options and you're just not sure what the exact differences are. So what I thought I would do in this video is actually compare a standard residential 25% down loan for an investment property and compare that to a standard 25% down commercial loan from something like a community bank or a private lender. So I'm gonna talk about the differences in this video and we're gonna get after it right now. What's going on, guys? My name's Lior and I'm a real estate investor out of Boston. And before I get into the meat and potatoes of the video, super quickly, guys, if this is your first time on my channel, first of all, welcome. Second of all, make sure you smash that subscribe button for me. I put out tons of new videos every single week talking all aspects of rental property investing, whether it's financing, tours of my projects, details on underwriting or management and construction, and everything in between. So if that's the kind of content you're looking for, make sure you subscribe to my channel. Now, with that, let's get right into it. And as I said, I'm going to compare the differences between getting a standard 25% down residential loan for an investment property versus going to a local community bank near you and asking for a 25% down commercial loan, or if you're going to hit up some sort of private lending company that will offer a loan for commercial lending as well. So I'm gonna go through a certain number of criteria and we're gonna dive into each aspect. So let's start out first with qualifying for the loan. Let's first talk about residential loans. It's pretty standard to your typical qualification process, whether you're gonna go buy a primary residence or buy an investment property, right? The lender's gonna ask you for your financials, look at your income, look at your debts, basically come up with a DTI ratio, right? Or a debt to income ratio. And if you're going for an investment property with a residential lender, you'll also be able to use, portions of your investment income as well in calculating how much you can qualify for on a loan basis, right? Now, most lenders, if you're going to go down this path, they're going to have to meet certain regulations, right? Depending on the type of loan products and everything. There's certain metrics that need to be hit from a DTI perspective. Now, if you're going to go through a commercial bank, right? Let's say you go to a local community bank. The process is similar, but there's some differences, right? Most community banks will, of course, also ask you for all your personal financials. So they'll ask for your income statements. They'll look at your debt sheets and everything. They'll probably also, try to figure out your net worth. They'll look at your credit score. They'll look at your net worth. But then they're also going to analyze the actual property itself, right? And what I mean by that is commercial lenders are going to go much more into the details of the operations of the potential property you're going to buy, right? So they're going to ask you to show them the cash flow analysis for that potential investment property. So for that bank, you're actually going to have to come up with a cash flow statement. We're going to show them the income. You're going to show them the projected expenses. And that's going to be part of the business plan that bank is going to evaluate, right? Because the bank is, of course, concerned with your financials and your balance sheet and everything you bring to the table. They're also just as concerned with the actual property, right? They want to make sure they're lending on a property that they like, that makes sense, that will have good cash flows operationally for the duration of the loan or for the duration that you own the property. So as you can see, it's similar in a way to residential lending, but it's a little bit more complex, right? Because not only are they going to evaluate your financials, but they're also going to look at the business aspect and the business plan of the property that you're intending to buy. Next, let's talk about the term of the loan and the amortization period of the loan. So with standard residential loans, it's pretty straightforward, right? Just like if you're buying a regular primary residence, if you're going to go put a 25% down on an investment property, you are typically going to get a 30-year term, right? So you're going to have 30 years for the mortgage, and it's going to be amortized on a 30-year schedule, just like most standard residential. Now, on the commercial side, it definitely gets a little bit more complex, and you can have terms that vary much more differently than just your standard 30 years, right? You can have mortgages that have terms of 5 years, 7 years, 10 years, 15 years, 30 years. If you're getting some sort of bridge financing, which I'm not going to get into the details right now, those have the potential to have even terms as short as a year, 2 years, whatever it is, right? So there's a lot more variability in terms of how long you can actually take the loan out for on the commercial side. Plus, the amortization is also going to be a little bit different, right? While it's standard on the residential side to have 30-year amortization periods, on the commercial sides, it can range from 20-year periods, 25-year periods, as well as 30-year periods, right? So there's a lot more variability. And again, a lot of this is going to come down to factors such as what kind of property you're buying for, what kind of business plan you have for that property, as well as the general loan products that specific lender or bank can offer. So just be aware you're going to have to balance a lot more different factors, and there's going to be a lot more variability in play than your standard residential loan. Next, let's talk about interest rates. So on the residential investment side, right, if you're going to go get a residential investment loan, then you're going to get a interest rate that's usually a little bit higher than the rate that you have for primary residences, right? So, to give you kind of like ballpark numbers, what we've seen the last, say, 4, 6, 8 months has been residential primary residence rates in the high 2s, maybe very, very low 3s, right? And interest rates for 25% down investment properties have been probably somewhere around like the low to mid 3s, right? So you're kind of pushing maybe 3.4, 3.5, 3.6, something like that. So it's certainly a little bit more expensive rate than your typical primary residence, but still a very attractive rate. Now, if you're going to go on the commercial side, and let's start with a local community bank, again, you're going to have some variance here, right? And again, each bank is certainly different. There are banks that can offer very, very competitive rates that are similar to the residential side, right? Where they're maybe in like that mid 3s range. But there's also some banks that might charge premiums of a half a point or a point, right? So the loans I typically take, they're usually around 4, 4.25. So I'm usually paying anywhere from a half point to a point higher than if I were to take a regular residential investment loan. Now, if you're going to go through the private lending sector, right, I'm not going to get super detailed in here right now, but let's say you're not going to go direct to a community bank, but a private lender, those rates can literally range from all over the place. I've seen rate products being offered from like 4% to as high as 10%. I know it's a huge range, but there's just so much variability and so many different types of loan products and lenders out there that it's hard to give a specific range. But just understand there's a lot more variability with the rates in, whether you're going to go on the community bank side or a private lender side. Next, I'm going to talk about construction, which for me is very, very important, right? Because a lot of my deals are value add deals that have typically some sort of construction component to them. So on the residential investment side, if you're going to go put 25% and get a residential investment loan, right, you are not going to be able to finance any construction, right? So if you have any construction or renovations that need to be done, those are going to have to be financed typically through cash or other sources, like if you have lines of credits or whatever, right? But you're not going to be able to get that financed into the loan. Now, this is a key differentiator for commercial loans, right? Because commercial loans certainly do offer that. They offer the ability to finance in your construction. Usually you can borrow up to 100% of the construction proceeds that you will need to complete the project, right? And that's obviously huge, right? Because that saves the amount of cash that you need to actually use. You can put down the 25% down payment for the acquisition component, and then you can actually borrow the majority or all of the construction funds that you're going to need for the project, which is of course critical from a cash management perspective. And the last thing I'll talk about in comparing these two is other creative terms that you can get, right? And with residential financing, it's pretty straightforward. There is not a lot of creativity, unfortunately, right? Residential investment products or residential investment products, you're going to put that 25% down. You're going to get that 30-year fixed with a 30-year term. And that's really what you're going to get, right? But what I love with the commercial side is you do have a lot of different creative structures and options depending on the type of project you need, right? So one of the things that really helps me a lot is, as I said, a lot of my projects tends to be distressed and are value add, right? So what that means for me is when I'm buying them, there's usually something that needs to happen, whether I need to increase rents or I need to do some sort of construction. So I can get what's called interest-only periods from these commercial lenders, right? So basically that first, say, 12, 15 months or whatever it is, the lender's not going to charge me a fully amortizing payment. I'm only going to be paying just interest payments, right? Which is huge for investors, right? Because this is all part of cash management, decreases your monthly cost while you're doing construction or trying to renegotiate rents, and kind of de-stresses the entire project. So interest-only periods have been absolutely crucial to my financing structures. Other things you can do is potentially get interest reserve funding, right? So some commercial lenders will actually lend you the first 6, 12 months of your payments, of your mortgage payments into the loan, right? So you're essentially borrowing your payments into the loan. Again, critical for cash management perspective. As an investor juggling multiple projects, you're going to want to figure out cash management is going to be huge, and having something like an interest reserve funded can certainly de-stress your entire operation. And there are a bunch of other creative terms that can come up with commercial financing, but typically those are the lenders that will get more creative if you're trying to do different structures, right? So they might be open to things like seller financing, whereas with a residential loan, you can really never put a structure like that together. So the point here is there's just a lot of different variables in play that, depending on the type of project, depending on the type of building or investment you want to buy in, you can kind of structure the loan as advantageously as possible for yourself to kind of create the perfect financing situation for you. So I know I just went through a lot of detail, and I know there's always a lot of confusion about this topic, but of course, if you guys have any questions about anything I said, just put them in the comments below, and I will definitely help you out.